Hello and welcome to episode number 9 of Mortgage Strategy 101. Today we will be discussing with you one of the key tips on how to optimize your tax deductions within your mortgage strategy. Today's tip is all about accessing your redraw on your investment loan to pay for your tax deductible expenses. And here's how it works. So basically, in this example, we have someone with an $800,000 home loan and they're paying an interest rate of 3.8%. All right. In their grow offset account, they've got about $200,000 of savings. So they're paying interest on about $600,000. On their investment loan, they have a balance of $450,000. The limit on the loan is $600,000. So there's access to redraw of $150,000 in this example, and the interest rate is 4.5%. Now many people will wonder, well, why should I be paying for my tax deductible expenses with debt rather than savings? And so I'll explain why. Essentially, if you're paying from your savings, you are then having less money in your offset account, which means you're effectively paying more interest on your home loan. Okay, so if you're paying the tax deductible expenses from savings, it reduces how much you're offsetting your home loan, which equals more interest on your home loan. Now the other complicating factor, if you like, to understand is people will think, yeah, but that's okay, my interest rate's lower on my home loan than it is on my investment loan, but not after your tax deduction. All right, so these are pretty common interest rates at the moment for an interest-only investment loan and a principal and interest home loan. So if your tax bracket is 32.5%, your effective interest rate is give or take 3.03% after your tax deduction. At 4.5%, and if you're on a 37% tax rate, then it's 2.8%. And if you're on the top tax bracket, then it's 2.47%. Okay, so the true interest rate cost of your investment loan is lower, 3.03, 2.8, 2.47, than the cost of your home loan. Therefore, you want to be paying more interest on your investment loan and less interest on your home loan. Okay, so let's say you've had some repairs and maintenance and the bill is $10,000. What you do is you then redraw $10,000 from your investment loan. So your balance would then go up to plus $10,000 makes it $460,000. 450 plus 10,000 equals 460. And your balance here would go to 210,000 in your offset for a day, let's say. But then you pay for your tax deductible expenses with that $10,000, but it's been transferred from redrawing your investment loan to your offset account, and then you pay for it. And what that means is overall, you have the same level of debt, but you have more tax deductible interest and less non-deductible interest. Whereas if you had to pay the $10,000 straight from here, you would only have $190,000 in your offset account, and therefore effectively you're paying interest on another $10,000. All right, so all these little things, all these little mortgage strategies, and there's big mortgage strategies as well, add up to more dollars in your pocket and less dollars in the bank's, or in this case you're optimizing your tax deduction so you don't have to pay the tax man as much, and you're doing it obviously legally. So I hope that made sense. Please reach out to us to understand more about how to optimize your mortgage strategy. And until next time, have a great day.